Okay. Thank you very much for being here. So this talk is about money market funds reform. Let me give you a brief outline. I will give you an introduction to explain what money market funds are. I will talk about their vulnerabilities. And then I will explain the reforms that have been put forward both by us and by FSOC over the past months. So money market funds are a particular type of mutual fund. In contrast to regular mutual funds, they strive to maintain what they call the net asset value fixed. What is the net asset value? Is the price at which investors can redeem their share in the fund. Okay? The way they do that is by using, as opposed to regular mutual fund, what is called amortized cost. That is, when they value a security, they value the price at which they paid it, adjusted for the amortization of the premium and the discount. The Investment Company Act specified as in order for them to be allowed to do that, they have to hold very safe, very liquid, and very short-term securities. Okay? Obviously, although they value security at amortized cost, the price of these securities do fluctuate in the market. The value of the share of the money market funds that would result from using market price is called the shadow price of the money market fund. The SEC allows money market funds to redeem their investor share at par, that is, at $1, as long as the shadow value is within 50 basis points of the $1 net asset value. So as long as they manage to keep their price per share within 50 basis points of $1, they can let their investors redeem their shares at $1. When the shadow price moves away from 50 basis points, the money market fund is obliged to reprice the shares, an event which is called breaking the buck, which is an extremely rare event. As a matter of fact, since the 1980s, occurred only twice. There is a very brief, I have a bibliography at the end of the presentation. There is a very brief introduction to money market fund pricing from the ICI. The number in brackets throughout the presentation refer to the list in the bibliography. There are several types of funds. There are funds that invest in tax-exempt products. There are funds that invest only in treasuries. By and large, the most important type of money market funds is what is called prime money market funds that invest in private debt instruments, like, for instance, financial commercial paper. They constitute more than 50% of the assets under management by the money market funds. Why do we care about money market funds? They are a very popular financial instruments. Just to give you a ballpark, they had at September 2007, September 2012, around 2.5 trillion in assets under management, and they are key providers of short-term funding. So, for instance, if you look at this table, financial commercial paper, they held roughly 40% of financial commercial paper. They were holding around 30% of outstanding certificate of deposits. So they are very big players. And on the other side of the leg, they also offer cash management tools for both wealthy individuals and firms and local and state government. Okay? So they have a dual role, one in supplying funds to financial institutions, and the other ones to allow both corporations and government and financial institutions to manage their cash. That's why they are so important. Okay? Now, of course, although they usually allow investors to redeem their shares at par, they do invest in products that have some credit, interest rate, and liquidity risk. And they have an investor base that is highly risk-averse. Basically, investors that invest in money market funds treat them as if they were bank's accounts and not a financial investment. So they expect to be able to redeem that investment at par. So get back all the capital they invested. Okay? Because of this reason, and because they do not have any type of insurance from the government, they are highly subjected to runs, as banks were at the beginning of the centuries. Where does the run come from? Of course, if I expect even a very small loss from my money market fund, what will I do? I will immediately redeem from the fund. Why will I immediately redeem from the fund? Because I know that if I redeem, I'm able to get all my capital back, and I will offload the loss to the other investors that did not redeem. Okay? So this bank run mechanism that applies to banks, for the same reason, also apply to money market funds. To give you an idea, these are assets under management in the money market fund industry from September 2008, when Lehman went bankrupt, to now. Okay? I want to concentrate only on the left side of both charts. The top chart refers to prime fund. The bottom chart refers to government fund. The red line refers to retail investors. The blue lines refer to institutional investors. What happened after Lehman went bankrupt? If you see, retail investors sold some of the assets, but remained basically flat. What happened is that institutional investors massively fled prime money market funds, which were the riskier, and moved their money to government money market funds that received a very strong inflow, around 500 billion of money, in a very short time, like 1-2 months. Okay? This kind of runs is what make money market funds a source of financial instability. Obviously, the runs may develop very quickly. They have two effects. On the one hand, they imply a loss of liquidity for the shareholder in the fund. They don't have access anymore to their money. And then they disrupt the short-term funding markets in which this money market fund invests. There is a recent speech by the bank president explaining the interplay between a run on the money market funds and wholesale short-term funding. Okay? This is a snapshot of the chart I gave you before. This chart represents the outflow from prime funds really around the crisis. Each point in this bar chart is 1 day in the crisis. As you see, the moment in which Lehman went bankrupt, money market prime funds experienced a very strong outflow of money. So as I told you before, the overall industry is 2.5 trillion. Prime is around 1.7 trillion. They had an outflow that between 60 and 120 billion a day in the moment in which Lehman went bankrupt. Okay? What did the government do? What did the government do? Treasury guaranteed all the assets of money market funds. The Fed introduced a set of facilities allow money market funds to offload their investment through commercial bank or to the Fed itself. Now, when there is a run, okay, one of the main link from the money market funds and the rest of the industry is through their sponsors. Who are the sponsors? Are the institutions that sell the money market funds to the retail or the institutional investors. Indeed, over the last 30 years, only 2 money market funds have broken the back. But, for instance, if you look at Moody's figure, there have been 144 cases between 1989 and 2003 of sponsors' investment into the fund in order to prevent the fund from breaking the back. In particular, between September and October 2008, although only one money market fund, Reserve, broke the back and had to reprice their share, there are at least 29 funds that had losses in excess of 50 basis points. And many of them, as you see from this histogram, had losses in excess of 2 percentage points in a matter of 1 month, basically. So these are very high losses for institutions that are supposed to invest in extremely safe assets. Where does the linkage come from? On the one hand, it goes from the money market fund to the sponsor. Why? Because the losses are usually borne by the sponsor who wants to shield its own client. And oftentimes, sponsors are systemically important institutions like banks. On the other hand, it goes from the sponsor to the money market fund. In some work done at the board by Patrick McCabe, for instance, he shows that sponsors that are perceived as being more highly risky because they have higher CDS spread, they own money market funds that suffered higher outflow during the crisis. Okay? So the risk can go in both directions. Okay? Finally, money market funds have been also a player in the international contagion between the US and the rest of the world. A case in example is that of Europe. Okay? Since 2011, concerns about the health of European banks, okay, led to concern about the stability of US money market funds. On the other hand, the fragility of money market funds in the US made even European banks more vulnerable. And over the last 2 years, we have seen basically a retrenchment that somebody dubbed like the quiet run of US money market funds away from Europe. Okay? If you see in this histogram, you see the percentage of a fund asset for a given number of funds. The dotted line is where basically US money market funds invested in Europe in June 2011. The red bar line is instead the same picture for August 2012. As the chart shows, there's been a retrenchment over the past year of money market funds from European banks. Finally, one of the reasons why money market funds are deemed to be in need of reform is that over the past 2 years, investors in the funds have in some way become more sophisticated. In particular, if we look at the behavior of institutional investors at the onset of the crisis, they barely budged. Instead, in 2008, outflows from funds varied significantly with the fund's risk. And in 2011, we have seen that funds pulled away from risk European banks, even though there was no loss realized in these banks. So we observe that over the past 2 years, these institutional investors have become much more susceptible, if you want, to news about riskiness coming from the money market fund industry. Okay? This is a chart that shows that. This is again asset under management, of money market funds. The red line are institutional investors. 2007 is the onset of the crisis. As you see, the institutional investors barely moved. Okay? What happens in 2008? When Lehman went bankrupt, there was a massive outflow of institutional investors responding to one money market fund breaking the back. What we see now in 2011 is that institutional investors are responding to the crisis in Europe by exiting the industry, although no money market fund has broken the back, and there were no losses, as a matter of fact, realized. So there is the perception that they have become more sensitive to the riskiness of this investment. Let me pause a second and give you an outline of the reform effort. Okay? After 2008, and after the first, if you want, emergency intervention of the government, the SEC adopted new rules to make money market funds more resilient. This rule implied new liquidity requirements. For instance, it was decided that money market funds had to have at least 30% of assets in liquid instruments. There were shorter asset maturities. They moved from 90 days to 60 days, the average maturities of assets held by money market funds. The more stringent credit quality standards, and above all, the SEC gave the board of money market fund the authority of suspending redemptions and liquidate the fund, something that they didn't clearly have. These reforms implied that money market funds were more resilient and implied that the likelihood of a crisis event was lower. But they did not address the institutional vulnerability of these funds. So to put it in that way, it's now less likely that risks materializes, but should risk materialize, the incentive of an investor to flee from the fund remains the same. For this reason, both the President's Working Group, FSOC, have over the past 2 years called for reforms of the industry. Okay? The SEC decided not to adopt new rules in August 2012, and in November, the FSOC stepped in and recommended that the SEC itself actually goes back and adopts some rules, some reforms. And in particular, the FSOC focused on 3 types of reform, and I will talk about them in detail in a second. One reform is to go to a floating NAV. The second reform is to use capital buffers. And the third reform is to adopt what is called a minimum balance at risk. Let me go through this reform one by one. Why do we want the reforms? What is the principle that should guide us in reforming the funds? One, obviously, you want to reduce the incentive for investors to run. So if you want to eliminate this fast mover advantage such that if I pull my capital away in face of losses, I offload the losses to other people. Second, you want to clearly allocate risks ex ante. Now risk is not clearly allocated. On the one hand, investors expect to be able to redeem at par. On the other hand, sponsors expect not to have to step in. Third, you would like to maintain the economic viability of these funds, and in particular, their ability to offer cash management services to corporations, the government, and institutional investors in general. Okay. So let me talk through these three options that the FSOC put forward. The first one is simply make money market funds as all the larger mutual funds and allow them to float their net asset value. So they would stop redeeming at par. Okay? This would have two advantages. On the one hand, it's very straightforward. Everyone understands it. It makes money market funds as all other mutual funds. Second, it also makes investors more aware that they are actually investing in a risky product, because as they invest in the money market fund, they invest in an instrument whose price fluctuates over time as opposed to be constant. What are the caveats? And that's why we think that this proposal has problems. Okay? One caveat is that although this proposal reduces the fast mover advantage, it does not eliminate it. And the reason why it doesn't eliminate it is because money market funds usually react to heavy redemptions by selling their most liquid assets. So if I think there are troubles, I still have an incentive to redeem as quickly as I can, because if I don't, okay, I will still be left with the most illiquid asset for the money market fund to sell and allow my redemption. The second issue is that the stable NAV is a key feature that allows money market funds to offer these cash management services, which are so important for the economy. Another proposal is to complement the current institutional arrangement with capital buffers. That is, oblige money market funds, like banks, to hold some capital. This has the advantage that it will actually reinforce the popular stable $1 fixed NAV, and it would allow the money market funds to operate even if it incurred some losses. Now, the issue is that it's a very costly proposition to raise all the capital, especially in the current low-yield environment. The third proposal has to do with redemption fee and restriction. Pure redemption fee and restriction were not among the proposals put forward by the FSOC. They have been put forward by the industry. What it means is that you allow money market funds either to stop redemptions or to charge a fee for investors to redeem. The reason why this reform, like the simple reform, is problematic is that it is very hard to see how restriction to redemptions or fee could at the same time halt a run and preserve money market funds' utility. In fact, in design a pure redemption restriction, you would have two alternatives. One, you would design a restriction which is always in place. That type of restriction will basically make the money market fund useless. Second, you could have a restriction that it's only triggered by a crisis, either because the board decides the money market fund is in crisis, or the SEC decides that, or some other entities. In that case, you really have to think that this could have a very strong incentive for investors to run before the restriction is put in place. So let's say that there is a fund that imposes a restriction on its investors. These investors are locked in. Other investors in other funds would immediately run in order to avoid the same type of restrictions being imposed upon them. The minimum balance at risk is a type of redemption restriction that alleviates this problem. It was proposed with a joint work by the New York Fed and the board in 2012, and it was adopted by the FSOC as one of the 3 proposals. It's a redemption restriction that's always in place, that creates a disincentive to redeem, and does not alter the operation of a money market fund in normal times. How does it work? The minimum balance at risk is a minimum balance, so it's a pot of money that you set aside. So it could be a percentage of your holding. Let's say I have $100 in a money market fund, it's 5% of this $100. Okay? As long as I don't touch this minimum balance at risk, there are no issues. If instead I want to withdraw these $5 out of my 100, this withdrawal is delayed for 30 days. That's one key feature. The other key feature is that any withdrawal that I do from the fund would put a proportion of this minimum balance at risk in first loss. That is, will become subordinated to other investors' minimum balance at risk. So let's say I have $100, my minimum balance at risk is 5, I withdraw 70% of my holding, 70% of these $5 would become in first loss. As soon as the money market fund loses some money, that's where the loss goes to. It goes to my minimum balance at risk because I withdrew. So obviously, this first loss position creates a strong disincentive for people to redeem if they think that the money market fund is going to break the buck and is going to be liquidated. Let me explain to you with a chart. In this line, you see on the horizontal line, I plotted a fund loss. On a vertical line, I plotted a loss for an investor. This chart refers to the current institutional arrangement. The blue lines refer to an investor who decides not to redeem. The solid blue line, it's an investor who decides not to redeem from a fund that suffers no redemption. Obviously, everyone loses proportionally, and the line is a 45-degree line. Okay? What happens as other investors decide to redeem, and they still don't redeem? These are the dotted lines that plot my loss if other investors redeem 25%, or my loss if other investor redeems 50%, respectively. As other investors redeem, I am left with a money market fund that has lost money, so my percentage loss is going up. So the more investors redeem, the more my loss moves to the left, the higher is my incentive to also flee. What happens if I redeem? This is the red line. Whatever I do, I experience no loss. So under the current institutional arrangement, there is a strong incentive for an investor to redeem as soon as he realizes that the money market fund may incur some losses. What happens when we introduce a minimum balance at risk? This is the same chart for a fund that has the minimum balance at risk rule. Let's look at the blue line. The blue lines are the lines of a non-redeeming investor. Okay? The solid line is exactly the same solid line as we had before. A non-redeeming investor in a fund where no one redeems. The blue dotted line are the losses of a non-redeeming investor in a fund in which other investors redeem something. As you see, the lines are moving to the right. What does it mean? It means that for any given loss in my mutual fund, I'm losing less and less money. That is, other people's redemptions have a beneficial effect on me because their minimum balance at risk goes in first loss position, and they shield me from the losses in the fund. What happens if I decide to redeem? You remember before the solid red line, which indicates my loss if I decide to redeem, was a flat line. My loss was at 0. Now, if I decide to redeem, my minimum balance at risk is in first loss. So I will immediately lose all my capital. That's why there is this jump from 0 to 5%, and the line stays flat. What happens if other investors redeem? My loss moves to the right. That is, it becomes smaller and smaller. Why? Because not only my own minimum balance at risk is in first loss position, but also that of the other investor. So we share it among ourselves. So to say it differently, the minimum balance at risk reduces, on the one hand, the incentive to redeem, but because of subordination, it actually creates a disincentive to redeem. If an investor redeems, the minimum balance at risk absorbs losses before non-redeeming investors' share do. Moreover, a positive effect that other people's redemptions, instead of being destabilizing, become stabilizing. In particular, the higher the redemption of other investors, the smaller the incentive to run. Why? Because redeeming investors' MBRs are in first loss position, and therefore they protect me. Now, we argue that in order to avoid the problems with rounding in the current institutional arrangement, the minimum balance at risk could be accompanied by small capital buffers. We suggest 50 basis points. Let me conclude. So the point of this talk was to explain what money market funds are and why they're important, and in particular why they are vulnerable to run, and why runs in the money market funds industry generate systemic risk. Because of these reasons, reforms are needed, and there are basically three options that have been put forward. One, the floating NAV, one, a capital buffer, and the third one, the minimum balance at risk. Okay, thank you very much.